Teresa was walking across her college campus on the first day of class when she was offered a free university t-shirt if she applied for a credit card. The t-shirt was cute, and Teresa didn't see the harm in applying for a card that she never had to use. Soon, Teresa learned that she had been approved for the credit card, and it arrived in the mail. Although Teresa didn't intend to use the card, she decided not to cancel it. She slowly began to use the card to buy gasoline or her dinner when she was out with friends. She paid off her balance in full each month at first, but after a while, she began charging more and more to the card. Once this started to happen, she was no longer able to pay off the full balance each month, and interest and other fees began to accumulate. Teresa found herself thousands of dollars in debt. Sadly, the situation above is becoming more and more common in society as the use of credit cards and other types of credit has increased. While credit can be a useful part of our lives, it also carries with it some risks that individuals need to be aware of as part of a successful financial plan. Credit is an arrangement between you and another party where you receive goods or services now and arrange to pay later. Consumer credit is generally thought of as credit for personal items, except for homes, that people want or need, such as clothing, vehicles, and so on. In this unit, we will examine some of the different aspects of credit and how to use credit wisely. Advantages of credit. Consumer credit has a number of advantages for individuals. It's become quite common for individuals to use it in modern society as we purchase goods like cars, furniture, and other items. We may use credit offered by a retailer from whom we buy goods, or we may use credit offered by a third party, such as a credit card company. One of the advantages of using credit is that it can be convenient. If you are making a large purchase, such as a car or a piece of furniture, you may not want to carry the cash to make the purchase. You may worry that the cash will be lost or stolen from you. Credit enables you to make the same purchase without having to worry that your money will be lost or stolen. In addition, we are buying more and more goods through online retailers in modern society. Credit enables us to buy these goods quickly and easily online, rather than having to go to a physical location to exchange money for the goods, particularly when the item is located far away. Another advantage is that credit can give you a float time between buying the product and when you need to pay for the product. When you purchase an item with a credit card, for example, you may have up to 20 to 25 days to pay for the item before interest is charged. This period, offered by many credit cards, is known as a grace period. After this period ends, interest is added to the unpaid amount. If you pay the full amount before the grace period ends, credit can give you this little window of extra time to pay. Credit can give you this little window of extra time to pay without incurring any additional charges. Using credit can also sometimes entitle individuals to special offers or advantages. For example, some credit card companies may offer limited insurance on the items bought with a credit card. Other companies offering credit may give rebates or incentives to individuals that purchase goods from their company. For example, some gas companies may offer a percentage of the money spent back to consumers for using their gas stations for fuel. Some credit cards also offer to cover insurance when the cards are used to rent vehicles. Disadvantages of credit. Although credit can offer some advantages, it also comes with disadvantages. If credit is not used wisely, it can have a large negative effect on our finances and on related areas of our lives. One of the main problems with credit is that we may be tempted to overspend since we don't actually need to have the money in hand to make a purchase. When we use credit, the money to pay back the debt comes out of our future income. This ties up our future income and prevents us from using that income for other purposes, such as saving or investing. Individuals also risk having their income decrease and having trouble paying the debt back to the lender. This is one reason why it's a good idea to think carefully about how you will use credit. Credit also tends to cost individuals more than paying in cash. credit is essentially a service that lenders are providing to you, and like other services, there are costs involved. Lenders charge interest on the balance of the debt over time. The longer someone takes to repay the debt, the more they will actually end up paying. In some circumstances, interest can increase the debt almost by thousands of dollars over a period of time. In addition, some credit can require application fees or yearly fees, as with some credit cards, and fees or penalties for late payments. The cost of credit can also affect other areas. Some insurance companies are now using credit history to help them determine insurance costs for auto or home insurance. Someone with debt may end up paying higher premiums than someone without debt. Failing to repay credit debt can also carry serious consequences. Not only can a failure to repay mean a possible loss of income or property, but it can also result in legal action. Some individuals may experience problems in their relationships because of their credit debt. Too much debt can prevent people from reaching their financial goals. Types of consumer credit. There are two types of consumer credit: closed-end credit and open-end credit. Closed-end credit is a one-time loan that you pay back over time in payments of equal amounts. Interest is charged on the amount lent, and it typically involves a specific amount and purpose for the loan. This type of credit is commonly used for mortgages, car loans, and installment loans for appliances and furniture. The seller may hold the title or ownership of the item until the loan is paid off. This type of credit is sometimes referred to as a consumer loan. Closed-end credit exists in several different forms. Installment sales credit is a loan that allows you to buy an item, such as a piece of furniture or an appliance, by paying a down payment and then agreeing to pay a set amount of money in installments until the loan and interest are paid off. Installment cash credit involves a direct loan of money for home improvements or other personal purposes. With installment cash credit, there is often no down payment required, and the payments will be a specific amount over a particular period of time. Single lump sum credit is a loan that needs to be repaid on a particular day. Often, the period of the loan is for 60 or 90 days, and at the end of that time, the entire amount plus any interest is due. Generally, a single lump sum credit is used to buy a single item, such as a piece of furniture. The retail store may offer the credit to eligible customers in order to encourage the purchase of a product. Open-end credit is loans made on a revolving basis with the repayment period not set. Open-end credit is also known as revolving credit. It is not typically used for a single purchase, but for many purchases over a period of time. Payments typically change in amount from month to month as the balance of the loan changes with new purchases or interest. Generally, the lender pre-approves an individual for a particular amount of money, known as a line of credit, and the individual is free to use any of that amount as long as the individual pays the money back at the specified times and in the specified amounts. Credit cards, Visa, MasterCard, etc., are perhaps the most used form of open-end credit. Credit cards can be used in a vast number of locations, including most retail stores, online sites, and most businesses. In fact, it is becoming harder and harder to function without a credit card in today's world, since they are often required for activities like renting cars, booking hotels, buying airline tickets, and shopping online. In addition to credit cards, there are a number of other forms of open-end credit. Many retail businesses offer retail cards, which are similar to credit cards, but which can only be used at the business offering the retail card. Banks may also offer something called revolving check credit, or a bank line of credit. This is a pre-arranged loan amount that you can access by writing specific checks. A bank line of credit generally has installments that you pay over time, and there may be finance charges based on the amount of credit used, rather than having interest charged on the amount of available credit. Sources of consumer credit. There are plentiful sources of consumer credit today. For individuals, this means that there are many choices to make about what source is best for their needs. Let's take a look at some of the more common sources of consumer loans and credit. Banks are one common source of consumer credit. Banks typically offer closed-end loans, and they are increasingly offering open-end credit as well. The interest rates and other fees will vary depending on the particular type of credit, and they may require some form of security for loans. They are also typically looking for individuals with an established history of credit. Credit unions are another source of loans or other credit plans. Credit unions tend to lend only to members, although there may be exceptions. Large loans may be subject to the approval of a committee of members, and borrowers may be required to have a cosigner or collateral for large loans. In some cases, the credit union may require that automatic payroll deductions be taken out to pay off a loan. Consumer finance companies may also offer loans and credit to individuals. These companies are more likely to offer unsecured loans and are more likely to lend individuals without an established credit history. The application process for a loan or credit is often quite speedy, with approval happening in less than a day in some cases. Applying for credit. In order to receive consumer credit, you need to apply for credit and be approved by the lending institution. There are a number of factors that influence whether someone will be approved for consumer credit, or whether that person's application for credit will be turned down. Overall, these factors make up your credit worthiness in the eyes of the lending institution. Understanding these factors can help you better manage your financial situation and prepare yourself for being approved for credit if you need it. The most widely used and important factors are the 5 C's of credit. Capital. Capital refers to assets that you currently own, such as houses, cars, investments, and so on. In other words, capital is the net worth of your household. Generally, the lending institution will look more favorably on an application if the person has more assets or capital than debt. Having more assets than debt means that the person could, if necessary, liquidate those assets in order to pay back the loan. Capacity. This refers to your perceived ability to pay back the credit or loan. Lenders may use a debt repayment ratio to help determine whether your income is enough to make it likely for you to repay the credit. They may take into consideration not only your income, but other debt responsibilities, housing costs, and the average cost of living in your area to determine whether you'll have enough money coming in to cover all of these different financial responsibilities. Collateral. Collateral means an asset that you are willing to use to back up a loan. For example, someone might place a home as the collateral for a loan. If the loan isn't paid back, the lender would then take possession of the item as repayment for the loan. So collateral involves the pledge of a specific item, such as a car, house, or other item of value to secure a loan. Not all credit or loans will require that an owned item be put up for collateral, but it can help to secure a loan in some cases. The idea behind collateral is that if you have an item at stake in the debt, you're more likely to do what it takes in order to get the debt paid, so you don't lose the item you put up for collateral. Character. Before giving you a loan or credit, lending institutions may want to know more about you to help determine whether you are a good person to give a loan or credit. They may want to know about your age, education, previous credit history, and your income. Essentially, the lender is looking to see whether you take your obligations seriously, whether you have experience in paying back a loan or debt, and whether you are a good candidate for paying back the money. Conditions. The circumstances of our lives can vary widely. We live in different areas, have different types of jobs, and earn different amounts of income. Lenders may also look at factors such as the locations that we live in or the economic opportunities that may be present. For individuals with either an insufficient credit history or a bad one, the lender may allow the loan or credit if a cosigner is added to the credit or loan. A cosigner is someone who agrees to take on the debt if you, the signer, do not make your payments and repay the debt. Given all the different factors that may go into approving credit or a loan, it is not surprising that some individuals may be turned down by a lender. When this happens, the individual may receive a letter that outlines why the credit or loan was denied. The reason for the denial may be insufficient income to cover the debt, not enough credit history, or negative information on the person's credit report, such as the failure to pay back other credit or repeated late payments. If a lender does look past some potentially negative aspects of the 5 C's of credit, they are likely to charge those individuals greater interest than individuals who have neutral or positive ratings of the 5 C's. Avoiding credit problems. In many ways, protecting your credit and avoiding problems relates to good financial management. One of the best ways to avoid credit problems is to use credit wisely. While it's a good idea to establish some credit experience, it's also a good idea to avoid using credit for everything. Using cash for most purchases can help you stay away from interest and other fees that raise the cost of what you are buying. When you do use credit, it's important to be realistic about the amount of debt that you can handle. It can be tempting to max out credit cards or use up credit once you have it. But the interest and fees can cost you money that you could otherwise use to help reach your financial goals. Once under the weight of high debt, it can be difficult to recover and get into a better financial situation. Once you have consumer credit, whether in the form of a credit card or a loan, one of the best ways to avoid credit problems and maintain a good credit report is to pay your bills on time. This is one area that the credit bureaus will look at when constructing your credit score. You can also protect or improve your credit by paying down any balances that you have over time. Balances below 30% of the total credit limit are advisable. Checking your credit report can also help you correct any errors that may show up. In some cases, a lender will work with you to resolve any errors. For example, if you have one late payment that's been reported, the lender may be willing to erase this report on request if you've paid on time otherwise. You'll also want to be sure that the information is accurate. For example, if you have a different credit limit than what is shown, you may benefit from having the correct information noted on your credit report. If you do have credit debt, you should first make sure that the minimum payments are made each month. Of course, it is better to make larger payments when possible, but it's important to first meet the minimum payment amounts. When payments are not made on outstanding credit debt, lenders will take a variety of actions in an effort to regain the money lent plus interest. When payments are not made, the lender may send you overdue notices via mail, email, or phone. If the past due amount is not caught up, the lender may send the debt to a debt collection agency. For those who do experience credit problems, there are many resources available to help them learn about how to solve their problems. However, it is important to make sure that the institution or company offering the help is a credible one. Unfortunately, there are many scams that take advantage of people who feel desperate over their credit issues and want a quick, easy solution. These individuals may experience even more difficulties and financial problems because of credit consolidation scams. Before working with an organization or institution on credit issues, look for warning signs. A reputable company or organization will not charge you for their services before those services have been completed. The organization should also disclose your rights clearly and share with you free services that may be helpful to you. It's a good idea to use the old adage, if it sounds too good to be true, it probably is, when looking for credit assistance. For those with credit problems, there are a number of reputable sources for help and information. Some of the best places to begin searching for information on how to solve your credit problems include the Federal Trade Commission, U.S., National Foundation for Consumer Credit, U.S., nonprofit credit counseling organizations. But make sure that the organization is a nonprofit and not a scam. Your local financial institution, such as a bank, consumer protection agencies. Whenever people look for credit help, it is important to thoroughly investigate the organization offering help and look closely at what you are agreeing to when entering into a relationship with a particular organization. Whenever possible, ask friends and family members for reputable organizations that have helped them in order to avoid scams. Understanding the different cards in your wallet. If you were to look in the average person's wallet or pocketbook today, we would likely find at least one credit card. Many people have multiple cards, but not all of these cards are exactly the same. Today, there are a range of cards that are considered credit cards, and understanding some of the differences between them can help you better manage your credit. Credit cards like Visa, MasterCard, Discover, and so on are common parts of modern society. We use them to purchase products online, pay for gasoline at the pump, and for easy credit when shopping in person when we don't have cash on hand. Some credit cards may be store cards that can only be used at the issuing retail store, while others can be used at any location that accepts the particular type of credit card. Most credit cards offer a grace period after your purchase, during which time you can pay back the amount without having to pay a finance charge. If the card has a balance owed after the grace period, a finance charge, including interest, is assessed to the balance on the account. Those who pay off their balances in full each month and avoid the finance and interest charges are known as convenience users. Those who do not pay their balances off each month are known as borrowers. Although they may look like credit cards, it is important not to confuse debit cards with credit cards. Debit cards are used to electronically subtract money from a savings or checking account to pay for a purchase. In other words, debit cards use money that you already have in your account, while credit cards extend credit, or money that you'll have to pay back to the credit card company. Smart cards are an emerging type of credit card. These cards have a computer chip embedded in the card that can carry a great deal of information, such as driver's license information, medical history, and healthcare information. These cards may be used for a wide variety of purposes in the future, such as allowing you to buy an airline ticket and automatically tracking your frequent flyer miles at the same time. There are some concerns about what types of information would be placed on smart cards and the security of this information. Stored value cards are also known as gift cards and prepaid cards. These cards have a prepaid amount of money on the card that is available for use. Many retail stores and other companies now issue gift or prepaid cards, and they have become common gifts for holidays and celebrations, such as birthdays or weddings. Gift cards are often issued for use at one particular company, but there are some cards, often issued by credit card companies, that can be used anywhere they are accepted. Increasingly, we are also seeing electronic gift cards that are sent via email and which allow individuals to purchase items at online retailers. Choosing a credit card. With all of the choices available in credit cards, how can you make the best choice? The way to choose the right credit card for your purposes is like many other aspects of successful financial planning. Different cards will be best for different people. The key is always to have your financial plans and goals in mind, and to find a card that best supports your plan and goals. What are some of the different aspects that you should look for? If you are brand new to the world of credit cards, a good place to start is with a gasoline or department store card. These cards will limit you to using them only at the issuing company. The credit limit is likely to be low, but these cards are a great way to establish some credit history and experience with credit cards. When looking for a credit card, shop around. Different credit cards will offer different interest rates, annual fees, and finance charges. If you plan to pay off your credit card balance in full each month, the best choice may be a card with no annual fee, or a very low one, and which has a grace period on the balance before finance charges are assessed. This gives you time to pay the balance during the grace period and avoid any charges. If you plan to carry a balance from month to month, you may be better off with a card that has a low monthly finance charge. Credit card companies often market and promote their cards heavily. They may offer free promotional items if you fill out an application. They may promise low annual fees. They may give you a low introductory interest rate on your purchases. However, it's important to do your homework before applying for or using credit. You may find hidden fees or charges that negate the benefits offered by the credit card company. If an offer sounds too good to be true, it probably is. Likewise, use caution if you have no credit history or bad credit history and a company offers you easy approval for credit. There will often be high finance charges or other fees. If you do experience credit problems, one way to reestablish a good credit history is by using a secured credit card. With secured cards, you submit money to the financial institution, and then you are able to use your credit card up to the amount of money that you deposited. This can give you access to a credit card without exposing you to high interest rates or finance charges. In conclusion, consumer credit has become an important part of modern society. We use credit to buy items and pay for them later, whether we are purchasing an item online or at a local store. Most adults today have some form of credit available to them, and learning how to manage credit is an important part of successful financial management. Without an understanding of credit and the impact that it can have on our finances, we might use credit unwisely and find ourselves in financial difficulties because of it.